Hello, everyone. Hope you're keeping safe and healthy. We take stock of the market and macro events that transpired for the month of October 2021. Coming to the equity market, global equity market continued to deliver positive returns in October. Indian equity, on the other hand, was flat to marginally negative. Small and mid cap were a mild underperformer. Year to date, though, Nifty has delivered 23% return and is one of the few emerging market nations to outperform developed market equities. Moderating returns in Indian equity is broadly in line with the expectations that we've been running for last few months. FII flows are sobering down, though the FII's participation in the Indian IPOs are quite robust. On the other hand, mutual funds in India continue to receive strong inflows into their equity schemes. Hence, both the domestic institutional investors as well as retail investors are still invested into the Indian equities. Rupee depreciated. In the very near term, a 74 to 76 against US dollar is something that we have in mind for Indian rupee. Globally, in October, COVID cases picked up marginally. In India, though, COVID cases are broadly contained and we have avoided an onset of third wave as yet. Vaccination is picking up across nations and in India too. Hence, because of the pickup in vaccination, this every research in COVID is having a less of an impact on economic activity. Coming to the domestic economic activity is picking up, though gradually. We are positive on the growth outlook for India, and yet we think there are some of the risks that one should be cognizant of. First is the supply dislocations, which are because of COVID. These are lingering longer than expected. And if they linger for longer, they will lead to some moderating in growth momentum and some cool off in the market sentiment as well. The second fact comes from China. If you remember last month, we had briefly discussed the property market issues and the power outages issue in China. Today, as a matter stands, policy makers in China are taking steps to address both these issues. But the fact of the matter is that Chinese authorities still don't want to loosen the leverage conditions or loosen the credit conditions for the Chinese property sector. The deleveraging of sector is something that they still have in mind. So, given this backdrop, even as financial contagion is avoided, growth risks in China are for real. And if such a big economy as China is to see a growth moderation, there will be definitely spillover effects into the real sector of other economies. The third risk is that we are gradually ending the monetary easing. There will be liquidity moderation, and at the same time, there are these inflation concerns. All this will have an impact on the demand and the growth momentum. One of the biggest highlights of 2021 is the return of the commodity cycle. In last few months, energy prices have picked up meaningfully and the non-energy commodities seem to have stabilized at a relatively steeper level. So what is leading to the rise in these energy prices? The demand recovery and the warmer weather led to higher than a typical pickup in the electricity demand. On the other hand, natural gas supply was broadly constant, so which led to a pickup in the rise in the natural gas prices. At the same time, there was a substitution demand for the crude, and crude prices are also picking up. Today, it is to the north of $80 per barrel for Brent. Investment in fossil fuels also have fallen faster than the replacements have come in line, which has aggravated these issues. And one final word, there were issues in some select other economies, which has also led to lower than usual production of the renewable energies. We have also seen an intensified worldwide discussion to tackle the global warming. COP26 discussions have commenced in Glasgow, and probably by the end of discussion, we will have a greater clarity on the numerical targets of the nations and sectors for achieving the net carbon neutrality. But it will not be a smooth path. As the world makes these energy transitions, there are bound to be unintended consequences and volatility during the transition period. Potholes include disagreements on the responsibility sharing between the EM and the DM countries. There could be carbon tax and there could be intermittent inflationary pressures as the world makes the transition to the greener planet. So overall, these commodity upcycles look here to stay in the very near term. The second point of discussion is that we have had earnings season commence in India for quarter two FY22. Broadly, the sales and profit have been healthy and in line with the expectations. The theme of this earnings season was broadly the rising commodity pressures and the input cost pressures, and businesses are having to take steep price hikes. And we have a little clarity on what that will do to consumer spending. Global supply issues, liquidity moderation, and now this inflation will have impact on the stock prices sooner than later. And yet, interestingly, we have seen some upward earnings revision for FY22 and FY23 where this is coming from mainly material upgrades to the materials, industrials, as well as IT sector, which is offsetting the cuts in the consumer discretionary. Financials have seen no material earnings revision. When we do bottom up stock analysis for the Nifty companies, it still predicts a plus 20% earnings growth for both FY22 and FY23. India is a structural story. It is being seen as a country which benefits from China plus one strategy. There is overall macro stability, and the reforms are there in place, which helps the businesses. And we are transiting to the digital economy very rapidly, which helps the associated tech companies. These factors and the fact that we believe that we are into a multi-year of earnings upcycle make us long-term positive on the equity market. Yet, we advise some caution in the very near term for the equity market. Global backdrop, which looked very much like a risk on sentiment, has now turned mixed and the broader market is not performing. Sentiments for India, which works as a contra indicator, also advise some caution. Valuation parameters for India on all count look very expensive. All these aspects advise some caution from the top down perspective. For the small and mid cap companies, valuation differential that existed until a year ago or even until a few months ago have now vanished, which means that the easy gains in these stocks aren't there and the risk reward is broadly more balanced. Hence, from a top down perspective, the positive narrative on the equity market is gradually ebbing, and the bottom up stock picking will take a stronger hold. Coming to the fixed income market, rates dynamic have changed very rapidly thanks to inflation, which has shown significant upside surprises. Shorter end rates have moved up across the emerging and developed world as market gets more aggressive in pricing an earlier start to the rate hike. While the debate on the fact that whether inflation is transitory or not continues, the fact of the matter is that global central banks are fighting the market pricing very hard. Select EM central banks have already started to hike rates. But as we have discussed previously, the fiscal stimulus in some of these countries to COVID has been larger than India, and their inflation has also surprised significantly on the upside relative to expectations and relative to their targets. But now, even developed central banks, which took exceptional monetary measures amidst COVID, are now gradually exiting from these measures. For example, Australia has given up on yield control, Canada abruptly ended QE, and UK is expected to commence hiking very soon. We have US Fed meeting in November, which will chart better clarity on their future course of action. Until now, there was criticism that India is probably behind the curve with regards to monetary policy normalization. And we believed otherwise, given the growth inflation dynamics. But now, as energy prices are rising, and the fact that India is a net importer of energy, probably the time has come to now quicken the pace of easy withdrawal in these easy monetary policy. RBI has a near 5% inflation in mind for next year, and there could be upside surprise. Take, for example, September print for CPI inflation, it was at 4.3%. But if you strip out the effect of food, particularly vegetables, this headline print turns out to be 6.7%. And dissecting in various ways, it does appear that the sequential momentum in CPI inflation is building up. Commodity cycle has returned nearly after a decade. In a true sense, the inflation targeting regime of India, which was adopted in 2014, will now get truly tested. Because post the adoption of inflation targeting, we have seen a very favorable dynamics on the commodity cycle. Businesses are having to take steep price hikes, and this is showing in the prices of household goods. Services inflation for households are still contained. That's probably because services haven't opened to the fullest scale. Eventually, you will likely see a pickup in the services inflation too. Pandemic differs from the other financial shock led recession in the sense that it is not only a demand shock, it is also a supply shock. For example, in India and in many other economies, you are seeing a pickup in the industrial orders. Yet, industrial production is slow to scale up because there are supply dislocations on account of labor and raw materials. If these issues linger longer and supply is slow to adjust, then inflation could be a bit more than transitory. And at the same time, we are witnessing this transition to green energy when the world is just coming out of COVID. So, if these cost-led pressures linger longer, it may get difficult for the inflation targeting central banks to ignore the relatively higher print in inflation, particularly now that the growth is now normalizing and we are broadly returning to the pre-COVID levels. RBI has also commenced on normalization in its own way. For example, it discontinued GSAP, it is moderating its bond purchases, it introduced BRRR, 14-day BRRR quantum are being scaled up, they're allowed to settle at a higher cutoff. And in October, we also had 28-day BRRR. So RBI is taking measures to address these excess liquidity in the system. An adjustment to LAP corridor may soon be in offing, which may eventually get followed by a pickup or liftoff in the key policy rate. Hence, both global and domestic dynamics on rates, inflation, and energy prices make us cautious on the rates. Even as interest rate hikes are being shifted forward, the challenge is that we have entered into an inflationary cycle when growth is not cast in stone. Hence, even as there may be an earlier than expected start to the monetary policy normalization, the strength of the rate hike, in other words, the terminal rate policy rate, may not reach the pre COVID peaks so easily. There are still a lot of uncertainties that prevail on growth and inflation paradigm. We still don't want to call out a judgment on the terminal policy rate simply because we want to have a better clarity on these all cost-led inflationary aspects and how long do they last. The fact that we have entered into monetary policy tightening, it, it means that the shorter end may react more aggressively than the longer end. Now, from the technical front, Indian government fiscal situation is extremely comfortable. Hence, it is likely that we may see lower than expected supply on the government bond side. But the challenge is that this is also coming with the likelihood of the fact that RBI may also moderate its bond purchases, and hence it may not lend a material positivity to the net supply of government security to the market. Valuation of government securities, whether you look relative to its own history, whether you look relative to equity market or peer nations, are broadly neutral or maybe marginally positive, especially with relation to the equity market. Coming to the corporate bond markets, fundamentals are positive. Corporates have been on deleveraging, which has reduced the supply of corporate bond issuances, particularly in first half of FY22. But the valuations are very attractive relative to GC. Hence, to sum up, even as technicals and valuations are broadly neutral for government bonds, fundamentals aren't very attractive, and that is why we advise caution on the rates. We are recommend trimming down duration and we prefer GSET over other assets. That's for this one. Wish you a very happy Diwali in advance. Stay safe.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.